Convener Devendra Mehta. Ladies and gentlemen, we are now on the last day of the workshop. I don't know what is your experience of the entire workshop. In this modern world, we always take and comments good about everything. So we are going to circulate a feedback form which where the name is optional, so you may write whatever you want to write about the entire workshop. May not talk only good about it, because your identity will be protected. Friends, coming to the session on taxation of foreign remittance on royalties and FTS, fees for technical services. As you have considered and discussed various nature of the income, you very well know that the most important topic and litigious topic on the entire gamut of foreign taxation is parallel, like business income and FTS and royalties. The most of the litigation has taken place in this area, and therefore we have a veteran speaker with an in-depth knowledge on fees for technical services and the royalties, Mr. Shabbir Motorwala here. To introduce him is a very dear friend. He is always available, even in busy schedule, in official work, etc. He always be frank. He says, Paresh, I can come on this day, that day, that day. Spare me on this day. This is how he talks, when he volunteers for speaking at chamber. So that's the best introduction for me about Shabbir. But he's a partner of BSR and Company, basically KPMG. He specializes in the subject of corporate tax advisory, the FEMA regulatory aspect, and the international taxation. He has about more than 15 years experience on this subject, and he is a distinguished student of CA, being a rank holder at both the examination. He has written various articles, he has spoken at various forums as a speaker on a basic level as well as on an advanced level. He is a versatile personality as such, and I am proud to present Shabbir before you today morning as the first session. Before I hand over the mic to Shabbir, may I request Jatin Bhai to present him a moment as a mark of our love and respect.
Thank you.
Shabbir, mic is yours.
Good morning, friends. Early in the morning, I was talking to Paresh Bhai. This is my hat trick inning on royalty and FTS. This is the third session that I am taking for the chamber in a sequence. January 2012, December 2012, and now in December 2013. Seldom some speaker gets an opportunity like this. I would like to thank Chamber for their friendship and confidence in me. I'll try and do my best today as well. Thank you so much, Paresh Bhai. Friends, those who have heard me speaking on royalty and FTS, there is one takya kalam I always use. The royalty and FTS are like Dharam and Veer of the film cinema in the Income Tax Act. So, as you have seen in Hindi picture, a hero always wins, no matter whatever is the situation, whatever is the difficulty, he always wins a battle. So we have this Dharam and Veer, in the Indian Income Tax Act. And the way they have been designed is that eventually Indian Income Tax Act will win over whichever way you look at it, unless there are some treaties which provide protection, and that's the way it is. And eventually if they have to lose, we have seen retrospective amendment in the Act, so the government is completely, the director is completely on their side. Okay, with that brief introduction, I'll just move on to my subject proper. What I plan to do today is give you a brief overview of what is royalty and fees for technical services, what is the taxation framework under the Act, what are the features of the model convention. We'll briefly touch upon concept of beneficial ownership in the context of royalties and FTS, concept of most favored nation clause. We will go through tax article constitution in the tax treaties and how taxation of that happens in the treaty. We will also deal with some selective issues in taxation of royalty and FTS. We'll also deal with some selected judicial precedents in 2013. We'll go through Form 15 CA/CB in the context of royalty and FTS. And lastly, question and answer. Friends, I would like to leave most time for question and answer. And I'm also aware that this has been a 4 days workshop. There has been overlap of many of these subjects. Some of the things that you may hear me speak may have been covered by other speakers, but I've tried to keep it as simple and as technical and as practical as possible. I would like to put question and answers towards the end so that we go with the flow. But yes, if there is an immediate need, you need an immediate question, please raise your hands and I'll be happy to answer. So friends, let's look at the provisions of the Income Tax Act and the DTA, and how do you break up the subject of royalty and FTS. The first and the foremost, in both the legislation we have to look at the scope. What is the scope of the royalty under the Act and what is the scope of royalty under the FTS? Then the second point that needs to be examined is when do the accrual arise in India for the non-resident. And the third thing that you need to examine is what is the nature of taxation. Will the nature of taxation be on gross basis or it will be on net basis, especially cases of royalty FTS attributable and effectively connected to a PE. Thereafter, one has to look at the compliance aspect, that is the withholding tax by the payer, transfer pricing, filing of return, assessments, appeals and stuff like that. Today we will only focus on the scope, accrual and taxation, and I am not dealing with the subject of PE. Let's look at the provisions of the Income Tax Act. Going to the basic section 5, scope of total income for non-resident. The income that is taxable is income received or deemed to be received in India, or income accruing or arising in India, or deemed to accrue or arise in India. So section 5 gives the charging of the income deemed to accrue or arise in India for non-resident. Then section 9 elaborates what is deemed to accrue or arise in India. And royalty and FTS were introduced from assessment year 1977-78, perhaps a year close to when I was born, and perhaps most of you are not even born at that time, especially the young audience. The term royalty is covered under section 916 and it has to be read with its explanation. Fees for technical services is covered under section 917 and needs to be read with its explanation. And royalty and FTS are deemed to accrue or arise in India if they are paid by government in all cases, a resident in all cases except where they are paid for business, profession or a source outside India. And the Act also deems royalty and FTS paid by non-resident relating to the business, profession or source in India as taxable in India. So the section 916 and 7 has an extraterritorial jurisdiction. Even when one non-resident makes a payment to another non-resident, there is a taxation in India which gets triggered and there is a withholding tax in India which gets triggered. Now, what is the word source in the section 916 and 917? It is now well settled, almost, that the source is not the payer of the income, but where the activities and business are carried out. Hitherto, people were taking a view that in case of exports, if there are any technical services paid by an Indian company, then the source, that is the exports are outside India, the payer of the export is outside India and therefore those FTAs are not taxable in India. But there was a decision of Delhi High Court in the case of Havels, and the High Court has clearly laid down the source is not the payer but where the business and the activities is carried on. So I think that is personally, according to me, the right view. Thereafter we have section 90 subsection 2, the basic section which says the provisions of the Act will prevail over the provisions of the DTA only to the extent they are more beneficial. Now friends, I would like to just spend 30 seconds over here. I know it's a very basic section, but I've seen many youngsters making one very, very silly mistake. Many people believe section 92 is optional. Section 92 is not optional. It gives you no choice. It gives nobody a choice. The treaty will prevail over the beneficial provision of the Act is not an option. What is beneficial is to be construed in general. With that we move on and let's look at the ambit of royalty under the Act, section 916. Royalty payable in respect of any right, property or information used or for services. So this is the basic section, and there is an explanation too to section 916 which says royalty means consideration including lump sum consideration but excludes income chargeable under the head capital gains. That means if there is a non-resident who is selling an intangible or who is alienating something or transferring something from outside India to India, that will not be in the nature of royalty, at least under the Act. And then what does the royalty cover? It covers use of or transfer of all or any rights including any granting of any license. So with respect to the following category, which is patent, invention, model, design, secret formula, process, trademark, similar property, copyright, there are a host of items which are covered over there. So if anybody is making any payment for the use or transfer of all or any right including granting of any license, that payment will be in the nature of royalty. Now, apart from use or a right to use, the ambit is further widened by covering imparting of any information. So, if somebody is just imparting information, there is no right to use or license. There is just a granting of information. Even that will be considered as royalty. And the most important part here is technical, industrial, commercial or scientific knowledge, experience or skill. And friends, we've come actually a long way in the litigation of royalty and FTS. Initially, we were used to fighting whether a particular payment is in the nature of royalty, FTS. People used to say make available. But this terminology, industrial, commercial, scientific experience also occurs in the treaty, and this is going to be the litigation of the future, because when somebody is rendering you some services, is he imparting you information or is he rendering you services? Because if he is imparting you information, you are taking it as services, then it will be royalty. Then we come to the third limb of royalty, which is use or right to use industrial, commercial or scientific equipment, excluding those covered under section 44BB, which is the presumptive section for oil and gas. And this section was introduced from AY 2002-2003. And then any services which is incidental to any of these activities will also constitute royalty. So this is the basic section, and thereafter, in the Finance Act 2012 actually widened the ambit of royalty with respect to what is known as computer software. And this widening was retrospective with effect from 1st June 1976. There was an explanation 4 which was added, which says, for the removal of doubt, it is hereby clarified that transfer of all or any right in respect of any right, property or information include and has always included transfer of all or any right for use or right to use a computer software, including granting of a license. And this amendment was mainly introduced to overcome a lot of judicial precedents which had held that with respect to granting of license of a computer software, especially shrink wrap software, it is a use of a product and an article, and it is not in the nature of payment for a copyright, and therefore it is not royalty. Many decisions are held in the context of the Act, most others have held in the context of the treaty as well. So the Act at least was amended by the government to try and tax computer software on a gross basis. India is an observer member of the UN Model Convention, and they have expressed the reservation that they reserve the right to tax royalty at source. They reserve the right to tax computer software as royalty. Then there was another explanation which was added to section 916, explanation 5, which talked about equipment or any other item, irrespective of whether you have the possession, whether you have a right to control, it will still constitute as payment in the nature of royalty. Again, this particular amendment was brought in because there was some decision which says that with respect to an equipment royalty, unless you have the possession of the equipment, unless you control the equipment, unless you operate the equipment, the payment will not be in the nature of royalty. Essentially, Delhi High Court in the Asia Satellite case. But then again, by the Finance Act 2012, it was attempted to override this particular angle of the definition, and it was clarified to mean that possession, control, right, all location, all that is not very relevant. Now, friends, here there was another explanation which was added, explanation 6. So apart from right control, there was another explanation was added in the context of process. And they said process always shall deem to have included transmission by satellite, uplinking, amplification, conversion of downlinking of any signal. Again transmission by cable, optic, fiber or similar technology, whether such item is a process or not. Again, here this particular amendment was intended to overcome many judicial precedents which had held that this particular activity does not constitute royalty, especially in the context of process and stuff like that. Here we have to note that the term transmission has not been defined, so probably we may have to go into the relevant regulation under the MIB rules to find out what is transmission. And the challenge this throws up today is, the way this has been used, and this particular definition is even relevant in the context of section 194J, where section 917 domestic payment also attracts withholding. And the way one would literally read this, even when you make a payment for a mobile service or a telephone usage at home or at office, it'll amount to royalty. The way it seems to be worded. But if you ask me, that's not the right way to read this legislation. There is a need to distinguish the exact arrangement between whether it is a service arrangement or whether it is a commercial arrangement with respect to that particular equipment. So when you are availing a general services, it will still, in my view, not constitute royalty. I'll touch upon that a bit later. But if the intention is to use the equipment or a facility in a particular manner, dedicated for you, not vis-a-vis the general public at large, then it may constitute royalty. So I think, in my view, still the law with respect to these explanation needs to get evolved under the revised legislation, and we'll have to see how the courts interpret these provisions. Friends, with that, I quickly move on to FTS under the Income Tax Act, covered under section 917.
In that case, the charter is applied to the...
I'll come to that. It's there. I'll come to that in the treaty and all. So explanation 2 to section 917 deals with FTS. It says consideration for rendering any managerial, technical and consultancy services. Again, all these terms, managerial, technical or consultancy, very widely, sort of understood by judicial precedents. Of course, management would mean in the context of managing a project, managing a company, managing any activity. The word technical, such as engineering, design, all those kind of stuff. The word consultancy means you consult somebody for what somebody ought to do. Again, very vast meaning given by various judicial precedents. Now, initially there was one school of thought to suggest that the word professional services like chartered accountant services are not covered under the word technical. This is especially because 194J uses the term professional over the word technical. So if you go and look at section 917 and you compare it with 194J, of course it's a domestic provision, but the distinction is eminent. The word professional there stands out, and it seems to suggest that the word profession may not get covered within the ambit of managerial, technical, consultancy, unless the services are of that nature, But however, there are judicial precedents which have held that no, professional services is something which will also fall within the ambit of technical services. Then there was another angle that since the word managerial and consultancy can only relate to human being, even the term technical will only relate to where the services are provided by human beings. And therefore the involvement of a human element is very critical for categorization as technical services. And this principle actually comes from the Supreme Court decision in the case of Bharti Cellular. I think I've written Bhartiya Cellular, but it is Bharti Cellular. There's a typo error over there. And of course there are several other decisions like the Bombay Tribunal in the case of UPS and all. And there are several other decisions which have followed this principle. And FTS includes provisions of technical or other personal. So if you have to just lend somebody, on a per day basis or a per hour basis for doing that services, where the intention is really to render services, even that will get covered. However, it excludes construction, assembly, mining, any like project or income chargeable salary, because these are all activities typically falling under 911, and they would typically be taxable on a net basis, and they would typically not have a large profit element embedded therein. Now briefly, very quickly, I'll touch upon one decision of Supreme Court in Ishikawa-jima, which seemed to have interpreted this provision to mean that in order to be taxable under section 917, there has to be a territorial nexus with India, and there has to be a live link with India, or the services have to be rendered in India. which actually was never the real way in which anybody would have interpreted this provision, but we had a Supreme Court saying so, and therefore the Finance Act 2007 actually amended again section 9 with retrospective effect to say that the taxation of royalty or FTS is going to happen irrespective of the place of resident of the non-resident, irrespective of business connection, or irrespective of where the services were rendered, or irrespective of whether the services were rendered in India. Now this particular amendment again is not very happily be worded. There was one decision, I think Karnataka High Court in Jindal, which seemed to suggest that the principle laid down by Ishikawa Jima is still very valid. I've not been able to do some more homework on decisions after that, but I'm not saying this is the right view, but this is one angle which one may need to keep in mind. Let's see how the law develops further. And then let's go to the taxation of royalty or FTS under the Act. So we are dealing with section 115A, which stipulates taxation of both royalty and FTS on a gross basis. And what are the conditions for this taxation? That when paid by the government, obviously it will relate to the agreement with government, but in other cases, the agreement has to be either approved by the government or it has to be in accordance with the industrial policy. Again, there has been a lot of water flowing around what is the meaning of this term, approved by the government or in accordance with the industrial policy, and many people believe, and I think there is some precedence to support that if a payment overseas is permitted under the foreign exchange regulation, then this particular conditions are satisfied. Now section 115A does not cover payments from non-resident to non-resident fully, except it says payments by an Indian concern. And therefore, typically if there is an NR to NR payment, it will not fall under this section. It has to be go by the general withholding under the Finance Act. There is one particular decision in the case of Bank of Credit and Commerce Mumbai Tribunal, which says that the Indian branch of a foreign company is an Indian concern. And prior to 2004-05, this gross basis of taxation was available only if the payment was to a foreign company. Today, whenever we make a payment to anybody for royalty FTS, it is taxation on gross basis, but this was actually not the case prior to 2004-05. Then let's look at the position till 2013 and 14 for agreements entered on or after 1st June 97 till May 2005. The taxation was at 20% on gross basis under section 115A plus surcharge and cess. And for agreements entered on or after 1st June 2005, the taxation was at 10% on gross basis. And this was one of the most beneficial regime because the 10% was either comparable or very acceptable from an income tax, from an international perspective, and most people did not mind paying this 10%. What happened from AY 2004-05? Other things remaining the same, this basic rate of 10% has gone up to 25%, and again it has to be increased by surcharge and cess. And friends, you must be also aware about the provisions of section 206AA, which says that if you do not have a PAN, then the taxation will be at 20% on gross basis. So this 20% on gross basis from 2014-15 is per se not relevant for royalty FTS because the basic rate itself is 25%. Unless there is a non-resident who is eligible for a treaty benefit, he has a tax residency certificate but not a PAN, then only you will apply this 20%. And then now we have another animal which has come on the block, which is known as section 94A, and which authorizes the government to specify a notified jurisdiction or an area where certain things like treaty may not apply, and there the withholding tax can be higher at 30% as well. And Cyprus was recently notified with effect from 1st November 2013. So if you are making any payment to Cyprus, the rate would be 30%. So we have to keep all these factors in mind when we actually apply it. Then there is a taxation on net basis under section 44DA with effect from AY 2004-05. I will actually not touch upon that. I think that has been covered by my other speakers in the course, so I'll briefly not touch upon that. But if you have a royalty and FTS which is effectively connected to a PE, then it will be taxed on a net basis. And the way the PE is defined is it is a definition of the PE under the Act read with the tax treaty, because the Supreme Court in Morgan Stanley has said that the PE definition under the Act is inclusive, and therefore even the treaty definition can be imported into the Act, and you have to read the treaty and the Act together for the purpose of PE. There is one anomaly which existed prior to 2004-2005 and which I thought I will highlight, is that in certain cases, even where there was a PE, royalty and FTS were held to be taxable on on gross basis, because in most cases Article 7, which authorized taxation of business profit says that the income will be computed in accordance with and subject to the limitation of the domestic law. So since the domestic law had 44D and 115A, in many cases of permanent establishment also the judicial precedent said that the taxation should be on gross basis and not on the net basis. This is one thing I just thought I'll highlight to the group. Then friends, with that, so this is the framework of the act, and let's look at what the model convention have to happen. What does the OECD model convention have to say? See, the OECD is far more advanced and it gives exclusive rights of taxation in the state of residence, unless the royalty is attributable to the PE of the non-resident in the state of source. That means it is not taxable in the state of source. Now many people have asked me why was the need to introduce this provision if it is not taxable. But I think the only reason I could think of why this provision still exists, a separate article exists in the OECD model convention, is because if the payments are not at arm's length, then that much royalty can be taxed as per the state of source. So I think they wanted to give that right, and then they wanted to cover that category, and therefore they have this article. Otherwise OECD could have actually done away with this article. And the definition of royalty is fairly simple. It is as compared to the act a far simpler provision, consideration for the use, copyright, literally, artistic. I will not go into the detail, but a far simpler provision as compared to, you've seen the act. The act contains a laundry list of items. OECD fairly simple items to get covered. And let's look at UN model convention. UN model convention is like our treaties. It grants the state of source the right to tax on gross basis and also on net basis if attributable or connected to the PE or a fixed base. Now, notable inclusions as compared to OECD model convention in the UN model conventions are films, tapes for radio and TV broadcasting. These are absent in the OECD, they are included in the UN. And what is also included in the UN is industrial, commercial and scientific equipment, which is conspicuously absent in the OECD model convention because it's a far more robust convention. Then let's look at the US model convention. US is very similar to OECD, but no exclusive right. There is notable exclusion of cinematographic film, notable inclusions for gains derived from alienation, which is contingent upon productivity or use or disposition. So if there is anybody who sells an intangible or gives you an intangible or transfers an intangible, but the payment is linked to the use of the intangible, then under the US model convention, that particular payment will constitute royalty. But only the gains will constitute royalty. It is not the gross. In all other section it is the gross, but here only the gains will constitute royalty. So this is the scenario under model convention. Let's look at fees for technical services, FTS. Now there is no specific article on FTS in any of these three conventions. So fees for technical services is generally on par with business income and it is taxable in the state of source only if attributable to a P. Then friends, let's look at how the Article 12 spells out in the treaty. The first Article 12.1 talks about distribution of taxing rights between the contracting state. The 12.2 puts a ceiling on the gross basis of taxation in the state of source. Article 12.3 actually gives out the meaning of the term royalty. So whenever you are reading a treaty, please read 12.1, please read 12.2, please read 12.3 in that sequence. 12.4 generally talks about taxation of royalty if connected to a PE under Article 7. Then Article 12.5 is the comparative provision of Section 917 as to when does royalty accrue or arise in the state of source. And in most treaties it is provided when the payer is a resident, the royalty arises in that particular state, or if the payer has a fixed base in that state of source, even if he is a non-resident, then the royalty arises in that state. And then Article 12.6 talks about adjustment for related party transaction. So excess of the arm's length price will not be eligible for the treaty benefit, it will go by the domestic tax provision. The FTS article in the most Indian tax treaty is structured on these lines. So there is absolutely no, if you see a royalty article or an FTS article, most of the treaties it is the same article, but in some treaties they are even different article. In general, you will find this scheme being followed. Now, it is to be noted over here is under the tax treaty, there is a limited accrual of royalty in FTS when paid by one non-resident to another non-resident. Like under the Act, there is a wide coverage of payments from non-resident to non-resident, but under the tax treaty, that coverage is very limited. That is only in the case where the payer non-resident has a permanent establishment in the source state. Apart from these provisions, most treaties also oblige beneficial ownership of royalty in FTS for the recipient to be eligible for the treaty benefit. So this is a concept that one needs to keep in mind. And many treaties also contain a most favored nation clause. And if you ask me, I'll explain the clause in a bit more detail as to what is the meaning of the most favored nation clause and how do you use it. So let's go to the concept of beneficial ownership. OECD Model Commentary 2003 says beneficial concept relevant for Article 1, 10, 11 and 12. 12 is the royalty which is relevant for us. It is mainly targeted to, curtail improper use of convention, and typically it is intended to deny treaty benefits to agents, nominees or conduits who are not entitled to treaty benefit. And then OECD has released 2 discussion drafts in April 11 and October 2012. The IBFD tax glossary defines beneficial owner is a common law term and it is distinct from legal owner. Professor Klaus Vogel says beneficial owner is a person who is free to decide whether or not the capital or the asset should be used or made available to be used, or how the yields to be used. So if I am free to use how the income ought to be used, I am the beneficial owner. Now the US Model Convention says beneficial owner is a person to whom the income is attributable for tax purposes. So if a person is liable to tax in respect of that income, he is the beneficial owner. And the Article 3.2 of the Model Convention says that if a term is not defined in the treaty, you have to go to the definition as per the domestic law. So should we look at the definition of beneficial ownership under our law under section 222(79). That's a dichotomy we have. Now friends, very interestingly, I just want to point out the CBDT Circular 789 dated 3rd April 2000 and issued in the context of India-Mauritius Tax Treaty for FIIs. It says tax residency certificate issued by Mauritius tax authorities is a sufficient evidence of the status of resident as well as beneficial ownership. And the Supreme Court in Azadi Bachao has said that the CBDT circular will prevail even if it is inconsistent with the provisions of the DTA. So even if the intention of the treaty was not that way, so long as this CBDT circular is valid, and we had seen some attempts to sort of take it to and fro by the Finance Bill 2013 when the Finance Minister was trying to amend Section 90 to sort of bring in this beneficial ownership in a slightly different way, and then it was withdrawn. So today the scenario is, so long as there is a tax residency certificate given, while it is not the correct international principle, but because of the CBDT circular and because of the judicial precedent, we can take a view that that TRC is not only an evidence of the residential status but also beneficial ownership. Again, I would like to caution, this is actually not the right technical view as well as not the right international view. Now in Hindi mein beneficial ownership, if I was to explain in simple word, means baap ka maal. If I can do whatever I want with that income, I am the beneficial owner. It is as simple as that. Yes. Yeah. Yeah, so that's a very valid point, and in my view, yes, it should apply. There is no reason why it should deviate, because this is laying down a technical principle and it is not on a specific facts. So that same technical principle should be extrapolated for other cases as well, in my view. So then let's look at most favored nation clause. The most favored nation means that two countries have executed a tax treaty. Thereafter, one of the country goes and executes a more favorable treaty with another jurisdiction, and the second one feels that I've got left out, because I negotiated the treaty before the second one. So the most favored nation means that there is a same benefit which were granted by one state of source will be granted to the first country of contract based on his treaty with another country. So he extends the benefit of a later treaty to an earlier treaty. Now in the context of royalty and FTS, it could be either a lower rate of tax or it could be narrowing the scope of income liable to tax. Generally, the provisions of MFN are contained either in the protocol or in the exchange of notes between the countries. The MFN clause is generally prospective. In many treaties, MFN triggers automatically. That means there may be no need for both the country to exchange any notes, enter into any protocol. Or in some treaties, the MFN gets triggered when both the countries have to come together, renegotiate, come out with a notification, an agreement, and then that agreement is notified, And I've listed few of the countries where the MFN exists in the context of royalty FTS, so Netherlands, Belgium, France, Sweden, Switzerland, And in all of these, either the rate or the scope sort of is narrowed. So not only when you look at the Article 12, after the Article 12, please go down to the end of the treaty, see if there is an MFN clause. And then you have to read that MFN clause and see how it applies, and you have to, vis-a-vis what are the provisions and how would you apply that MFN in the context of that treaty. So friends, with that I move on. I briefly want to touch upon independent personal services, because most of the Indian tax treaty also contain IPS. I know one of my colleagues speaker would have dealt with it. The only one limited point that I have to express over here is, in most Indian treaty, like the UN Model Convention, we have this Article 14 on independent personal services, and in many treaties it is expressly mentioned that if the category of services are those which fall under Article 14, then the provisions of Article 14 will prevail over the provision of Article 12. And in my view, that principle is valid even in those treaties where such principle is not mentioned, because whenever there are two clauses, the most specific one will prevail. And this is actually a more wider, more beneficial provisions for non-resident. So further, let's move on to the royalty analysis under Indian DTAs. So according to me, in general, there are four situations that could arise, which we should practically keep in mind. One is the presence of an article on royalty very akin to our income tax provision. In that case, it is very simple taxation on gross basis, and it is a simpler method of taxation for non-resident. In second situation, the scope of the royalty is restrictive as compared to the ITA, and especially we've seen tax treaty exclude industrial, commercial, scientific equipment, and many other exclusions are there, and this could be subject matter of litigation. In some cases, I have seen that the scope of the royalty article is actually more exhaustive as compared to the Income Tax Act. Like, they have got cinematographic film gains on alienation like the US treaty, and therefore the non-resident here can choose to be governed by the provisions of the Act, And the fourth situation is where the royalty is attributable to or effectively connected with a PE in India, in which case there is a taxation on net basis. These are generally the four scenarios that you would typically look at when you analyze any real life situation. Now let's look at some of the selective Indian DTA. So in the scope, in the US treaty, items like ships and aircraft used in international traffic, the payment for that is specifically excluded. In the Ireland DTA, the payment for the use of aircraft is specifically excluded from the ICS. In the France and the Netherlands treaty, industrial, commercial, scientific equipment is specifically excluded from the ambit of royalty. In the US DTA, gains contingent upon productivity, disposition or use are specifically embedded in the concept of royalty. Singapore also includes alienation right of property information, and in such treaties the fundamental question that comes up is alienation similar to transfer? And whether alienation is wider or transfer is wider, I will really not get into that, more a subject to be dealt by like capital gains. But in general, for all practical purposes, I would tend to believe that this is more or less is the same meaning. Alienation and transfer are more or less, if at all alienation is wider, because it includes transfer as a part therein. Then in some recent tax treaties like Morocco, Malaysia, Kazakhstan, we've seen that the words computer software are specifically included. So we've seen some of these variations, that the terms computer software is specifically included as one of the items which will be chargeable to tax in India as royalty. Friends, moving on, we go to FTS. Now again, in FTS we will have typically four situations. One situation will be absence of article on FTS. So in many treaties you will find that there is no FTS article at all, such as Mauritius and the UAE. Therefore, whenever there is a payment from India, those payments are then in the nature of business profits. They are taxable only in the state of residence, and they would not be taxable in India, of course subject to tax residency and all the other stuff. Then the second situation is presence of article akin to the Income Tax Act. Again, here the life is very simple. Taxation is on gross basis, very similar to the Act, and it's a simpler method. Some examples are like Japan and Germany. The situation 3 is the scope of the FTS is more restrictive than the Act, and we'll discuss that in the next few slides. And the situation 4 is where the FTS is connected to the PE and taxed on net basis. So let's look at the scope of FTS article restrictive as compared to ITA, and one of the most, everybody refers to the example of the India-US DTA, and the notes and the protocols there too, because it contains a very unique concept of make available. And what is this concept? It includes only technical services or consultancy services in the technical field. It includes services ancillary or subsidiary qua royalty. So when it uses the word technical, the word managerial is absent over there. It excludes all services which are incidental, subsidiary or essentially connected to sale of goods, other than that constituting royalty. And it compasses a make available concept, and we will see what is the make available concept. And it has a new clause on development and transfer of a technical plan or a design. And I would just like to spend a minute over here. So if there is a design, and if it is specifically developed for you, and even if it is sold to you, it can never be a capital gains transaction. It will always be a service, because a tailor-made design can only be a service. There cannot be an alienation of that in the classic sense, because he has made it for you. And therefore, the term development and transfer of technical plan or design is covered within the ambit of services, and it will typically not go under capital gains in most cases. Okay. And of course, there is a specific exclusion for personal use of by the payer, or paying payments by educational institution in such field. Now, what is the concept of make available in the India US DTA? The concept of make available means person acquiring the services are enabled to apply the technology. That means after receiving the services from you, I become like you. I am able to do the same thing that you are able to do. The transfer happens in such a manner that I am equipped to carry out the same technical activity with the same level of efficiency. Merely because the service provider is using technology does not itself mean that the make available condition is satisfied. So what are the examples of make available? Engineers helping Indian manufacturers on how to produce the product, modifying product formulas and training employees. And in general, periodic repairs, inspections of machines will not constitute make available. The concept of make available exists in more than a dozen treaties I have given directly, and due to MFN clause again I have given examples. So this concept is now prevalent in almost 15 to 20 tax treaties that India has. In some tax treaties like Australia, FIS is included, make available is included within the definition of royalty. Now there are several judicial principles which have said that the principle and the examples given in the India-US DTA can also be used in the context of other DTA where similar provision exists. So again, you can actually freely rely on all these examples and this judicial precedent in the context of any other tax treaty. So friends, I am conscious of time. I am moving on to my next issue. Let's look at some selected issues in royalty FTS. And since most tax treaties use the word paid in the context of taxation of royalty or FTS at source, what does the word paid mean? And the OECD Model Convention says that paid has a very wide meaning. It means fulfillment of the obligation to put funds at the disposal of the creditor in the manner required by the contract or by custom. So in general, paid should not basically mean cash basis of accounting. I mean, that's what I'm trying to tell you. But however, there are certain decisions in the context of India, in the context of treaties which have held that the royalty FTS are taxable only when they are paid to the non-resident. Means physically the payment of cash. But if you ask me, that is really not the right way. If you make a provision, if you are contractually liable to pay, you made a provision, it's an effective payment, in that sense. It's cash disbursement is not payment in the classic sense. But again, there is a difference of opinion there. And then we have a couple of old decisions and one recent decision in Booz Allen, which has said that if there is any payment which requires any regulatory approval, say for example the RBI approval, and if the RBI approval is not obtained, then the accrual itself has not happened. And therefore the payment has not happened, and therefore the royalty FTS is not taxable in India. Now we know that under Article 3.2 of the tax treaty, the term not defined under the treaty has to be given its meaning as per the provision of the Act. So what is the word paid means? Paid under section 43.2 means actually paid or incurred as per the method of accounting. So here the word payment is linked to the method of accounting. So again, if you made a provision, you put something at the disposal, the term paid seems to get satisfied. And the question that needs to be sort of answered, or the law that needs to be developed over here, is whether the above definition would be relevant in the context of Article 3.2 as well. Then friends, let's move on to the next issue, whether these royalty retrospective amendment, whether they impact the tax treaties. Article 3.2 defines that the terms not defined under the tax treaties should have the meaning as per the domestic law. And the OECD and the UN model recommend an ambulatory approach. That means as and when you apply the law, you have to look at the law of that date and not the law on which the tax treaty was entered. There is a decision in the context of Before You International, and I think there are a couple of other decisions which have had that this amendment has no effect because the provisions of the treaty has not changed. So that means these explanation 4, 5, 6 which are there in the Income Tax Act cannot be imported for the purpose of treaty. They cannot be read into the treaty. They were not there when the treaty was executed and they can't be even otherwise read. So long as there is no change in the DTA, those provisions will not impact the way used to interpret the tax treaty. And there are other decisions like WNS, Mumbai Tribunal, Nokia, Delhi High Court which have followed these principles. Again, the language in all of these judicial precedent is not very happily worded, not very clear, but these principles are quite apparent and arguable. Friends, with that, briefly we'll just touch upon software taxability, and I think most of us sort of seem to struggle here. And most of the software supply constitute shrink wrap or off-the-shelf software. That means a software which is available for use by everybody. It is not tailored for you, it is not customized for you. What has the tax authorities been traditionally trying to argue is that software involves use of copyright, patent, invention, process, blah blah blah, and therefore it is royalty. What the taxpayers have been arguing that what we are using is only a copyrighted article, there is no right to use a copyright, people have fought on the copyright law and therefore it is business income and not taxable in India in absence of a PE. And people have placed reliance on OECD model and international precedents. And this issue still continues to be under litigation both before the amendment, before the introduction of the explanation to section 916 and even after the explanation to section 916. And we'll just quickly look at what were the recent 2000. And again, friends, I've chosen to ignore some of the old decision because we have to really now look at decisions which have dealt with the treaty and the act and the revised provision. And since the provision came in only by Finance Act 2012, we have only a few instances. Of course, there are more, but I've selected a chosen few here. So we have this decision of Infrastrof in the Delhi High Court which have said that payments for computer software are not royalty because they were only for the use of a copyrighted article and they were not for the payment for the use of any copyright. And we have the Converges decision by Delhi Tribunal which has also followed the Infrastrof principle as laid down above. However, there is one recent decision of Reliance Infocom where the Mumbai Tribunal has not followed the Delhi High Court view and they have said even payment for license to use shrinkware software or off-the-shelf software is in the nature of use of a copyright and therefore royalty under the Act as well as the India-US DTA. So again, now we have a scenario where we have a High Court and we have a Tribunal and we have decisions which are sort of going once again the each other. There is another Delhi Tribunal in Microsoft which seems to have not looked through the Infrastrof decision and has followed Reliance Infocom. But again, while this is not a subject for today, in general, whenever we are faced with such conflicting situation, we have to follow the rule that what is the decision to be followed, whether a High Court has to be followed over a tribunal, whether jurisdictional tribunal is binding, whether a jurisdictional High Court is binding, whether a non-jurisdictional is binding. Again, this is a subject in itself. I would not like to touch upon it as of now. But there are decisions like the Prasad Production Madras Special Bench which I would recommend each one of you to read because it lays down that in a case of conflicted judicial precedent, how do you follow? When should you follow a particular High Court? When should you follow a particular tribunal? When should you particularly follow a special bench decision? So it gives elaborate guidance and again there are other decisions laid down in that decision which help you to sort of clear these fundamentals. Friends, with that we move on to the recent decision on transmission and we have this decision in the case of Verizon Communications Singapore, Madras High Court which has gone actually against the taxpayer where the bandwidth payments to non-resident for private lease circuit was taxable as royalty in view of the retrospective amendment to the definition of royalty under the Act and it was held to be royalty also under the treaty. But we have a Converges decision, another decision of the Delhi Tribunal in Converges which has said that linking charges paid to telecom service providers and cross-charge to the Indian subsidiary as reimbursement, they are not in the nature of royalty because they are not in the nature of income in the first place. And then we have another decision of WNS Global to support that reimbursement of lease line is not in the nature of income. So we again now have a mixed law which is evolving which says that if there is a reimbursement then there is no income and no royalty. But if otherwise the amendment may need to be read, there is one at least Madras High Court which says that you have to read the amendment for royalty into the treaty as well. Friends, with that we move on to some recent decisions on e-commerce scenario. There was a decision in eBay 2013 Mumbai Tribunal where payment for India-specific website was held not to be FTS, and this was under the India-Swiss DTA, because you say that when you actually operate it's a commercial service, it's not FTS. And we have the decision of the Right Florists in Kolkata Tribunal which says online advertising fees paid to foreign search engine is not royalty FTS, India, US and India Ireland Treaty. Now friend, I think here fundamentally what each of us as practitioners need to keep in mind that while we have this section 917 and the international tax and the treaty, we also have a lot of guidance under section 194C versus 194J as to how each of these items is characterized for domestic law. And in my view, most of these principles, most of these circulars can also be sort of embedded and used even when you are analyzing international scenario. So typically advertising is always covered under 194C under the domestic law. So technically yes, it can never be a royalty or an FTS under 194J. And there is a CBDT circular which says that each of the TDS section is a very specific section and there is no intended overlap between the two. And if you actually are not taxable under one of the section, you can't be pulled into the other section. Friends, let's look at few royalty plus make available decisions that came in 2013. And we have one very interesting decision of the Cochin Tribunal which actually dealt the context of management services, and some training etc. was also given. Now these management services and training was in the context of software development, and therefore the tribunal said that because the management is in the context of software development, it was technical in nature and the make available condition was satisfied because the Indian company was able to develop the software. So again, now there is a backdoor entry by which people are even trying to argue that managerial services could also satisfy the make available criteria, whereas if you look at the India-US tax treaty protocol, it is very clear that only technical services in the technical field need to be tested for the make available criteria and not otherwise. Then we have this two decision in the case of Marriott, and there are a couple of other decisions as well in the context of the hotel industry where marketing fees and sales and marketing fees paid under sales and marketing agreement are not taxable as royalty. Because people were trying to allege that you are not paying for the brand name and you've created a separate stream of payment for marketing fees for rooms and blah blah blah. But the many judicial precedents have consistently held that yes, if the contract provides no payment for the intangible or a trade name, and if the contract provides specific payment for services, then you can't actually recharacterize the payment from payment for services to payment for brand name. And then we have this decision of WNS North America which states that marketing and management services make available not satisfied India US DTA. So this is I think a Mumbai tribunal decision. You can see contrast it with the Cochin tribunal decision. There is another decision of the Mumbai tribunal in United Heli Charters which talks about pilot training as per DGCA rules is not FTS. So even training over here, when you train somebody, because it's an individual training, you are not enabling the organization as a whole, and they are saying it is not make available, it is not FIS under the India US DTA. Then there is another decision of the Ahmedabad tribunal in Vida Clinical which says that general training not involving any transfer of technology not FTS. So if you are giving just some general training to somebody, even if it is a training, even if it is technical, there is no make available, not FTS, India UK DTA. And we had one most applauded AR which came in after a large gap was Eruditus Education, and they have sort of upheld the principle that teaching by educational program is not in the nature of FTS, it's in the context of the India-Singapore DTA. So these are some of the decisions which came in 2013 and which in my view, some of it lay down the right principles, some of it we need to tread with caution, and they give it a lot more insight to the decision that we already had on this subject a little earlier. We have seen so many conferences discuss so many of these. I thought I'll deal with only a very few selected ones. Then friends, going ahead to some other decisions in 2013, there are two decisions which I wanted to touch over here. One was Angelic International and Faizan Shoes, and they dealt with export commission for procuring export orders, and they said that they were not taxable in India as FTS. So again, a very welcome decision. We have these, many times we want to make payment for export commission, import commission, and the dichotomy that we faced is whether that payment is in the nature of FTS and whether it will be taxable in India. And we have now these two decisions, Delhi High Court as well as Chennai Tribunal, which seems to support this proposition that business services could not be characterized as FTS, in general. Then we have one, again, a very landmark decision of Siemens, by Mumbai Tribunal, which actually upheld the principle of Bharati Cellular Supreme Court, which said that in absence of human element, testing of circuit breakers mainly done on machine is not FTS. So a fully automized process can never be an FTS under section 917. Then we have another very good decision of Mumbai Tribunal in Credit Agroquel Indo-Suez, which says data processing charges paid to HO is not royalty, as there is no use of asset. There the department was trying to argue that when you pay to somebody for a data processing, it is for the use of server, equipment, blah blah blah, and therefore royalty. He said nothing doing. This is for services, not. And of course there were other decisions like Standard Chartered Bank, a lot of decisions which came in 2012 as well. And then I come to one of the most talked about decisions recently, Pumpahar Shipping, Madras High Court. And this was the question which the gentleman here asked. Where the High Court seems to suggest that ship is also an equipment and payments for hiring of ships are royalty under the Act or the DTA. And they've sort of really gone to lay out this principle, which technically, if you ask me, is right, but perhaps not entirely right, because definitely the term aircraft and ship in a larger sense are equipment, and if you're fully leasing them like a dry lease, then definitely it will be a royalty. But if you're leasing them with the intention to render services like a wet lease with crew, with fuel, with all the supplies, and the intention is really to avail services, then classically that would not be royalty. I think that you will have to look at each agreement very carefully. So I was just explaining in the context of India-Ireland DTA, the term aircraft is excluded from the ambit of equipment royalty. Now that clearly means that the intention otherwise is to include aircraft as a part of equipment. So definitely ship is also a part of equipment, but the whole idea is, was the whole ship leased? Was the ship given in possession? Was the payment used for the use of the ship, or was it for transport? That is the fundamental question that needs to be answered, and I think each contract, once we we'll have to analyze to see whether it is payment for the use of equipment or it is payment for the use of services. If it is for the use of services, it will not be royalty. But if it is a plain vanilla use of equipment, which is say a rental of a ship for 1 month, a pure dry lease, then definitely it should constitute royalty in the first place. Friends, then we had one decision of Universal International by the Bombay High Court. I think, I'm not sure whether it's Bombay High Court or Bombay Tribunal. I think we'll check that. Which is in the context of beneficial ownership. Now in this case what happens was, there was a foreign company which was owning a music license. It actually sub-licensed that music to another foreign company, and the second foreign company then licensed it back to India. And when India paid the music license royalty, that royalty was upstream to the ultimate, the main licensor. And the treaty benefits were tried to be denied, saying that the recipient foreign company is not the beneficial owner. And here the court observed that, look, TRC is again sufficient evidence of beneficial ownership. They've held this, in the context of, India-Mauritius Treaty. This is actually a Netherlands decision in the context of India-Netherlands Tax Treaty. And they have referred to the CBDT Circular 789 in the context of Mauritius Treaty, which was again a question that was posed to me. And the beneficial ownership of sub-licensor was upheld. So even now here we have an arrangement where there are licensor, sub-licensor, and India is actually paying to an intermediary. There are decisions to suggest that in certain specified cases the beneficial ownership condition should be construed to be satisfied. Friends, with that, I think I'm well within time, and I'll move on to my next, item allotted to me for discussion is Form 15 CA-CB. Now, there was a notification 67 which came in 2nd September 2013, effective 1st October 2013, and Rule 37BB now expressly lays down that information in 15 CA and CB is to be furnished only if the sum payable to non-resident is chargeable to tax. And this is also in line with section 195(6) and is in sharp contrast to the earlier Rule 37BB that was proposed by notification 58 from 5th of August. And there between the two notifications, there was also a list of items as to what is taxable. There was the earlier one had a 39 item list, and the second notification has a 28 item list. But in my view, if you ask me, that list is irrelevant. It's only an illustrative list. It does not mean that only those items are not considered to be non-taxable in India, and that's absolutely a wrong notion. I think that most of the bankers do not understand the law, and they are actually paranoid, and if there is any item falling outside the 28 list, they panic. So that's actually really not the right way of looking at it, and we have to explain to them that that explanation only makes it clear what is the legal provision. That is not the only legal provision. Now let's look at some of the key issues. That is what I picked up, from my own, and I must admit that I don't issue too much of these 15 CVs, so please bear with me. I checked with few of my friends who do this quite regularly. So, the first point which I thought I will discuss with this wider group is, that the Form 15 CA needs to be signed by a person that is competent to sign the return of income. And this poses practical difficulties because most of the time the payer is the general manager, the CFO, he may not be a board member or the managing director. In every, companies like listed company make thousands of remittances every day. How are they going to put this machinery in place? And with respect to an Indian company, you can't even have an authorized signatory, who could sign the return, which is unlike a foreign company. You can have any authorized signatory who could sign a return. So this poses practical difficulties. I'm really not sure, how people are addressing this. While every one of these 15 CA is going to the managing director, I don't know, and how he's going to deal with that. Typically it has to be signed by either a chartered accountant or a company secretary within the company. That would have been good enough. But be it that way, the judiciary choose that it has to be signed by somebody who's authorized to sign the return. And then there is a one part A of Form 15 CA which seems to say, okay, things will be simple if you are paying only less than 50,000 or in aggregate the payments have not exceeded 250. Now here one point to be noted is, it talks about payment made and payments made already. It does not talk about estimation of the future payment. So we really don't need to estimate the future payment, aggregate it and see whether they exceed 250,000. At least that's the way I read those provisions. Whereas some other provisions like 194C, 194J, they talk about standalone payment plus other payments during the year, estimated aggregate. So here really there is no such aggregation that is warranted.
Yes, sir, here the limit is qua payee or qua payer?
Sorry, it will be qua payer. No? How the payee ka limit? How would I know? It is qua the payer.
Individual remittance.
Yes, qua payer for that pay. That is at least my view. Then friends, one funny thing which I found over here is that you are forced to analyze the provisions of the Act. Even where the DTA is more beneficial, it says provisions of the Act, provisions of the treaty. Why do you want the provisions of the Act to be there? And then it makes it all the more evident, you just have to say you select whichever is more beneficial and just fill in that, And at least what we have done is that we at least write that provisions of the Act have not been analyzed because they are construed to be, provisions of the treaty have been construed to be more beneficial. We just skip that section. That's really not necessary to fill that. Just put a note and I think that should be good enough in my view. Now, one interesting thing which suggests, these forms suggest that the remittance could be for net business income or even capital gains. Means that is computed income. Whereas typically the principle that was coming from the earlier decision of Samsung and GE, all the Supreme Court decisions earlier, that in the context of Section 195, you could took the CA route only if the payment was taxable on gross basis. Only if the remittance was taxable on a gross basis. And anything which required computation, something like business income or a PE, you must make an application to the tax office. By and large, that was the more appropriate, and I'm sure the speaker on the 195 would have dealt with that. But this form otherwise goes on the otherwise and seems to suggest that even a chartered accountant can compute a net income of a PE and the remittance can be made, which is, in my view, something which we'll have to see whether we are bold enough to sort of go ahead and do it. And what kind of documents we'll take on record to sort of say that this is the right net estimated income, or because the income will change every remittance. And again, one thing which I found little bit unacceptable was there is no provisions for notes or positions that are adopted. So there is no way in which so I'll have to attach an extra sheet, or maybe they should have put one box where we could have easily put what is the reason. I mean, they talked about some reason, but some elaborate provisions for note doesn't exist. So These are some of my key issues which I thought we'll highlight with the group. Friends, with that I'm well within time. I wanted to leave a bit more time for question and answer, and I will be happy to take them. Thank you so much.
We have 10 minutes for the questions. No questions?
So the last time you said that whether DTA is more beneficial, whether taxability under the Act should be mentioned or not in that particular point. But there it is mandatorily supposed to be filled in from 15 CA. So,
but that's, see, the rules cannot override the provisions of the Act. It's very clear. You just say that the provisions of the treaty are construed more beneficial and the Act provisions have not been analyzed. And there are judicial precedents to support that, like the IPCO's decision in Pune Tribunal. That's very clear. It says that you don't have to analyze the provisions of the Act. You can straight away go to the treaty and say these are beneficial. There is no need to prove this is beneficial or that is beneficial. So in my view, the rules cannot override the statute and the legal principle.
So by this answer, you mean to say that in 50 CA, in case DTA is beneficial, then the questions asked for this as per Income Tax Act needs to be completely ignored and needs to be left blank.
Absolutely, that is a doable proposition in my view.
And this the limit you talked about for 15 CA, that would be for 50,000 and 250,000. That would be remittances by a payer to that payer.
To that payer, yes. Vis-a-vis that payer, vis-a-vis that payer. Only that much. That's it. Nothing more. Because you have no way of knowing what he has done otherwise, what the other payee has done otherwise across. See, basically that's look, we are all accountants and we need to respect the materiality threshold. So basically what income tax is saying, if you're just paying 50,000, forget it, I'm not interested in anything. I don't think they'll go after you.
Sir, online subscription paid for the subscription of websites for preparing data or research report, whether it's royalty.
So I think very good question. Perhaps I did not touch upon that. See, that will depend on whether the data is copyrighted, protected or not. If it's a general information, then you may be able to argue that it's not royalty, you are just accessing general information. But if it's a copyright protected data, again we have judicial precedent like Dun and Bradstreet, we have ThoughtBuzz, a lot of other decisions are against and to and fro. But the essential element that you have to see is whether the data is copyrighted protected. And if it is a copyright protected data, then most likely department will argue that it is in the nature of royalty. But if it is not copyrighted, it is general information, then it is fine. It's a simple compilation. Like for example, some sites give you access to all newspaper report at one place, some market information at one place, which is really not copyrighted. It is just general statistics. That is fine. No, it is not his own information. No, he is collating only information in public domain. So he is not imparting his information. You can also take it down from the public domain. That's really not the right way to look at it.
But what about analysis of a company's data, like its financial performance, etc.?
That is services. No? That will go by technical, commercial, managerial. So depend on what is the analysis.
The analysis of the financial statement.
So it will be like consultancy. You are taking help of. It will be taxable unless the TTS make available or something like that.
Sir, can you explain the subclause B of 917 that the source of the income is outside India?
Yeah. So when a resident is making payment to a non-resident, if the payment relates to a source outside India, then it is not taxable. And typically source, as I have explained, is not the payer of the income to the resident. So the payer of that income could be a non-resident located outside India, but it is where the activity of the resident is carried out. So for example, if I am exporting and I am exporting from a factory in India, then the source of that export is in India. But if, for example, I have a software development center outside India as a branch, and if I have made some payment in connection with that branch, then that source of that income is outside India, and that particular payment will then not be, deemed to accrue as in India under that clause B. So you have to really look at the source. So if you have a project outside India, if you have a branch outside India, if you have a factory outside India, typically those will be the example of sources outside India.
Sir,
marketing survey expenses paid outside India, is it FTS?
The marketing survey in general should not be FTS because it's a standard business services. There is nothing technical, managerial. If it's a general information that you are collecting, but if there is an analysis which is involved, like if they just give you a dump, collect and give you a dump, that's a. If they do an analytics, then we may have a challenge unless there is a breakup. If there is a real analysis, because your objective is to get a processed data the way it is, then it should be FTS. Yeah.
Charges are being paid to the company, and therein some version is updated to a remote server by the vendor.
This is a software maintenance, you're saying?
Yeah, and in that case, the version is updated or some patches to a remote server. Would it constitute as a royalty, or I mean, like how it works?
No, so that will depend on whether what you have given the treatment to the principal. In most cases.
Usually, the software is developed.
Right.
Then it would be a FTS by the but later on in the later stages of the year, when the software gets developed, there is only AMC charges and it's a kind of version upgradation or a patch upgradation.
So that's like a payment for the software only. Though they are saying it is AMC, you are getting an updated software. So it's still payment for the software only. Though they are saying unless they are doing a call center kind of an operation, like if you are in trouble, they run a patch. Yeah, so that is incidental, that service is incidental to the main payment, which is either the sale or royalty. So that will go with that main characterization. But if they run a BPO or something, then you will have to see whether it is FTS or no and whether that help is technical or no. So there are different. So I'll tell you the whole problem with this is the industry, does an agreement in a particular manner and the entire law is in a different manner and we are trying to interpret, like we are trying to. Yeah, so I'll explain. See, most of these agreements are done keeping international principle in mind because they would like to follow the OECD model. And in the OECD, FTS is not an article. So they want to say everything is services. Even if there is a license, they say it is services. And they want to get away from royalty. And in India, when they do like that, they get trapped under FTS. So it's a chicken and egg situation. Where they are successful elsewhere, on the same agreement, they will not be successful in India. You really have to look at the intent. And I have seen a mixture of everything. And really you have to do a hair splitting to understand, and at least from under 195, the payer has to be conservative. Let the recipient take an aggressive stand if he wants.
Sir, payment is cloud computing.
Same principles. Same principle. Absolutely. It is the same principle. Now I am saying whatever principle you apply in hard, what you apply in earth, you have to apply in cloud also.
Sir, if service is not chargeable under a treaty, because service is not chargeable under a treaty, but under the act it is chargeable, whether Form 15C is used.
Yeah, so the rule is very clear and the sections are very clear that these forms need not be issued, but I don't think practically the banker will allow you to remit the money. Therefore, you may eventually end up issuing one. But if you ask me the way the rule is worded and if you contrast the rule with the earlier rule which came in August, and the way the section is worded, is very clear that these forms are to be issued only if they are taxable. But unfortunately, that's not the practice. So we have a law and we have a practice which are different from each other.
But if you see the details which is asked in those.
Yeah, even non-taxable income is covered because they are presuming it will be. See okay. Now the whole point is, it seems that they want to exclude only items which are undoubtedly not taxable both under the Act as well as treaty, which for example supply of goods. But if one is taxable under the Act and not taxable under the treaty, they may still insist on 15 CACV. So that angle you need to consider, that it is not taxable because of the treaty, otherwise it is taxable. Therefore 15 CACV may be warranted, but something which is purely not taxable like imports, supply of goods, there 15 CACV is surely not required. But in other cases, technical view not required, but practically people will insist because if they want to know your analysis and you have done your due diligence before making that remittance.
So, fees paid to merchant vendors outside India for possible acquisition of a company, whether it will fall under acquisition of 917, whether for purpose of business outside India or for earning an income outside India.
If you ask me the question only on that clause of exclusion, it will not, because the assets will come to India. You will own it from India. The company that will acquire, you will own the shares from India. So its a source is in India. When you sell that company, it will be taxable in India, right? So it's a source in India in that sense. In the sense the company is connected to India.
Possible acquisition of land outside India.
Possible acquisition of a plant then can be a source outside. That's what I explained. If it's a branch or a factory, then but that is practically not possible under FEMA. So it's only a theoretical situation.
Sir, softwares as of now, since there are conflicting decisions under the DTA, whether it is to be taken as FTS or as business profits, what is the situation we should adopt as of now?
But that depends on the risk appetite of your client. You have to tell him if he wants to fight, not deduct. If he doesn't want to fight, please deduct.
And sir, just one more thing, managerial services, they are covered in section 9 in that definition, but if it's not falling in independent personal services and the definition of professional fees, since it says include certain services, so if it's not falling into that, and in FTS it is not supposed to be considered if it's purely managerial in nature, not being technical. So in that case, it should go in the business profit clause, and if no pay, no tax.
Sorry, I didn't get your question. Sorry.
If it's purely managerial in nature, the
services are purely managerial in nature. Okay. Okay.
First, if you go to the
So consultancy cannot be managerial. I am very clear. Consultancy and managerial are two separate baskets.
Okay,
in consultancy, you don't manage. You just tell him what to do. That's it. That's the end of it. In manage, I take the responsibility and I'll manage a project for you, which is different. I may not consult you. I may not tell you why I am doing this. So these are two separate categories, and people really just mix it up like anything. That's why I mentioned in my example that these are all three different limbs, and you really can't mix any of the three. So I wouldn't say managerial as consultancy and consultancy as managerial, except where they are very commonness is there because of the typical facts. Otherwise they will be different.
But both are covered in 917.
That's fine. So now what happens?
So what I'm trying to say, basically non-technical in nature.
Yes.
So if it is professional, first we see the specific article.
IPS 14, yes, independent personal services.
We see FTS.
You don't have to see FTS. If it is not falling under IPS, you are out. You don't have to go to Article 12. That's what I told. You don't have to look at Article 12 at all then. Your IPS not taxable under the treaty and the IPS, that's the end of the analysis.
Okay. Okay, so if it's falling, if not falling in FTS and the make available.
You don't have to go to FTS if it is IPS.
In another situation, I'm saying.
Okay.
If as per the Act, it is taxable as fees for technical services.
Forget the Act. Everything is taxable. Dharamveer are undefeatable. That's what I'm trying to tell you. Let's forget the Act. Let's look at the treaty. What happens under the treaty?
Right, so if independent personal services is not applicable in that case. We are comparing the...
No, if it is some services rendered by chartered accountant, then all services rendered by chartered accountant will be professional services irrespective of whatever nature. You don't have to do a hair splitting of that. Services by engineers will get covered. So all types of services by engineers will get covered. There you don't have to do the breakup of managerial, consultancy, technical. So you are out, you are out. You don't have to go into the other Article 12 there.
Yeah, her question is coming to India, UK and India, US treaty. Make available.
Sorry?
Make available project.
No, her question was slightly different. It can apply in other treaties also. It's not necessarily make available. Because if you are under IPS, you are far safe. That's why UN, yeah, sorry.
Once transfer to a plant, whether the form 15 CB will be required.
No.
As same analogy of...
The bankers insist because they don't understand income tax. That's the whole problem. It's only a transfer of fund. There is no income only.
So, in ideal cases, 15 CACB is to be obtained before making payment. But in certain cases, there are direct debits made to the accounts. For example, if a bank maintains a Nostro account with other foreign banks, the charges are directly debited from that account and we do not get an opportunity to file 15 CACB. So, how to comply with the same?
Yeah, so there are other situations as Pareshwar is mentioning. I think that should be a question for 195, not to LTA case. Not my subject, and I don't know. Did the speaker take this kind of question? I don't know. No, so okay, I'll attempt to answer. Okay, so the whole thing is even if it has got withheld, okay, you should take at least 15 CACB on record and keep
at
it.
a later point.
Yeah, whenever you come to know. Whenever you come to know, you have to take, so for example, payments by credit card. You may end up making payments by credit card and then the banker has no role to play, but you have to obtain 15 CACB. That in my view should be complied with to demonstrate that you followed the rule to the T to the extent possible.
So probably we can take a stock at the end of the month.
No, as and when the deduction or payment has happened. You can't take stock at the end of the year. Sorry.
No, at the end of the month or something.
No, at the end of the month it's okay. I mean, as soon as
account
possible.
statements get generated only at the end of the month, so we come to know.
Please request him to generate something like this simultaneously. Yeah, absolutely. So at the end of the month, obviously, Paresh Bhai is mentioning you have to pay the TDS within 7 days from the next month. But I would suggest that because you would have passed the NT, because the TDS liability is triggered payment of credit.
Yeah.
So if the payment of credit has happened, it is ideally that we take, we don't wait for that 7 days. So whatever it is, you adopt that position and take it on record.
Okay, okay, thank you.
So if we go a little bit further, we can take a form which should be always required that whether the TDS has been deducted. Then we are supposed to see whether TDS has been paid later on within the framework. Is it the responsibility associated with the form vacancy? In our word, we just pick whether the tax has been deducted. Yes, client says yes, I have deducted tax. We take it that whether subsequently pays or not, that does it affect our any liability?
Well, technically no, if you ask me, because the time limit is available. See, what happens is that you may deduct on today, say on the 15th of a month, you have time to pay the 7th and the remittance has to go on 16th. You may have time, you may take a view, but you have to put a note. And subsequently, if he has not paid, you will have to put a letter to the officer to say this has happened. You have to keep a track. Yeah? See, the code of conduct also gives us some responsibility of the institute's code of conduct. So I would say you should not blindly go on deduction. You should maybe you issued a certificate, that's good enough. But the whole objective is that you should logically follow it up till the tax is paid. Because we don't want to go and issue CDS certificate to somebody who doesn't pay the TDS then. I mean, as a good consultant, we don't want to be associated with such people.
Wait, it is a certificate just saying that this income will chargeable to tax at this rate. This is the certification.
Right, so, no, it is a certification of what the payer has done. It is not even an opinion in my view. It is just a statement of fact. I am not giving an opinion whether it is taxable or not taxable. The certificate in my view is only a statement of fact as to what the payer has position adopted by the payer. That's it.
That's correct. But then whatever I am certifying is this type of income.
Yeah, but
able to tax at this rate.
You are not satisfying. You are only satisfying what the payer has done. It may be wrong. It may not be your view. It doesn't say in my view it is chargeable to tax. It never says that.
No. As per the act.
It doesn't say as per the act. It is as per what the payer does.
I mean, what was the chargeability?
As per the payer, what view he has taken. I'm sorry. I'm very clear about that. No, that's okay. That's okay. He may ask you, but in many cases, payer don't ask us also. So we have other cases as well. So we really have all types of people, and we have to take them on board.
Sir, how will you go ahead with services paid to a lawyer for fighting a case outside India, where you don't have a treaty with that country? So then it will be covered under business income under.
No, it will be FTS.
So it will be purely an FTS.
Yes.
It will get covered under managerial or which schedule?
No, technical. Professional. The term professional has been inbuilt into technical. There is, I think, GBK or some Karnataka High Court is there.
So in that case, that regulators case law, they have held it as not FTS.
No, that is because that was India-UK tax treaty. That was under a treaty.
Even if there is a treaty.
He is referring to a case where there is no treaty.
But if there is a treaty.
So this is a reverse case. That is non-resident coming in India and fighting in India. His case is different.
So if a non-resident.
Yes.
If a non-resident is given a professional fee in the say lawyer's fees.
Yes.
So would it be considered in technical?
It is first IPS. So unless in the IPS the challenge is it is generally eligible to only individuals or firms of individuals. So if you are paying to a company and
it's a firm, suppose instance, for instance.
So it will not be taxable under IPS under the treaty first. That's the first principle.
So whether FTS or not, because still it is a professional fee.
So you don't have to go to FTS. No, I mentioned that. If you are not taxable under IPS, you are out. You don't have to go to FTS at all.
And suppose it is
You can't have double coverage of the same income. You don't have to rule out the non-taxability under two clauses. That's what I'm trying to explain.
Sir, if it is paid to a company outside India, then yes, you said if it is a firm or an individual, IPS would be independent personal service. But if it is paid to a company,
so unless the treaty, so if the treaty has a rigor that it applies only to individual or firm of individual, then you are not in IPS. Then you will get covered under FTS. As a company, you have to test FTS for the company. Yeah. That's a good question. You will have to read Article 3 with the Act. It depends on what is the constitution of the LLP under the local law. Whether it's a body, incorporate, partnership, and then read it with the treaty. It's not no one case answer fit for all.
Thank you, Shabbir, for enlightening us on all questions. May I request Devendra Bhai to make announcements and vote of thanks.
first the announcements. The International Tax Committee of CTC has organized NRRC on 28th of February and 1st of March. Then there is a formation of a new study circle, namely TP Study Circle, which will be dealing all TP items threadwear. And each first meeting is planned in January 2014. And there is a long duration TP study course is planned during the month of February and March 2014. May I now request Surbi to just propose a hearty vote of thanks to Shabbir bhai.
Firstly, I would like to thank the Chamber for giving me the opportunity to propose this vote of thanks. Sir, thank you very much for explaining this topic so well, starting right from the income tax provisions from Section 9, what was the situation before, what was the reason for the amendment, and after that what happened, right to the model conventions, then going to the specific DTAs and explaining the articles, and then going on to so many case laws you discussed, sir, on this topic. This topic is so confusing. I think that having so many case laws since each and every situation is specific. So in that case, he discussed so many case laws, it will be very helpful for us in that case. And I really appreciate the fact that, sir, you had the patience to listen to so many queries, because each of them are case specific. So actually understanding the query and then answering and having the patience to answer is not an easy feat. It's very difficult to have the patience to answer that. And lastly, I would just like to conclude with, it is rightly said that a good teacher does not lead you into the house of his wisdom, but rather leads you to the threshold of your own mind. So what sir has discussed today, he's given us numerous case laws to go through. So whenever we have any situation now in front of us, we won't get a direct answer. We have to refer to whatever judicial proceedings have been said and then try to apply what we have learned today and come to a conclusion. So thank you very much, sir.
Friends, we will break for the tea for 10 minutes and we'll reassemble at sharp at 11:15.